There's a stock in your portfolio right now that you should have sold months ago. You know the one. It's down. It's bleeding. And every single day, you tell yourself the same thing: I'll sell when it gets back to what I paid. But here's the brutal truth. The market doesn't know what you paid. And it doesn't care. I've spent 50 years watching investors make this exact mistake. Smart people. Disciplined people. People who'd never gamble at a casino. And they hold losers for years. There's a name for this. Psychologists call it the sunk cost fallacy. And it has quietly destroyed more portfolios than any market crash ever has. Today, I'll show you the real research behind it, a famous fund manager who fell into it, and the simple question that gets you out. Let's start with a number you can't argue with. In 1998, a finance professor named Terence O'Dean studied 10,000 real brokerage accounts. Real money. Real trades. And he found something disturbing. Investors sold their winning stocks far too early and clung to their losers. But here's where it gets really interesting. The winners they sold went on to beat the losers they kept by about 3.4% over the very next year. Think about that. People were systematically selling the good and keeping the bad. The exact opposite of what works. So why do we do it? It comes down to a single, very human idea. A sunk cost is money you've already spent. It's gone. You can't get it back. And it should have zero influence on what you do next. But emotionally? It feels like everything. And that is the trap most investors never even see. Here's the part that surprised even me when I first learned it. Two psychologists, Daniel Kahneman and Amos Tversky, proved something remarkable about the human mind. We don't feel gains and losses equally. Losing $100 hurts about twice as much as gaining $100 feels good. This is called loss aversion. And it's wired into us. So when a stock drops, selling it means admitting the loss is real. It means feeling that pain. Twice over. So what do? We avoid it. We hold. We hope. And we tell ourselves a story. It's not a real loss until I sell. Sound familiar? But that story is a lie. The loss is already real. The money is already gone. You're just refusing to look at it. There's even a famous version of this outside the market. Britain and France spent decades funding the Concorde jet, long after they knew it would never make money. Why? Because they'd already spent so much. Economists literally named it the Concorde fallacy. Governments do it. Companies do it. And yes, investors do it every single day. Now let me tell you about someone who was supposed to be immune to this. Bill Miller. For 15 straight years, from 1991 to 2005, his Legg Mason Value Trust Fund beat the S&P 500. 15 years in a row. Nobody had ever done that. He was a legend. A genuine value investing icon. Then came 2008. The financial crisis. Miller's funds were loaded with financial stocks. Bear Stearns. AIG. Freddie Mac. Countrywide. And as those stocks fell, he didn't sell. He bought more. He averaged down. Again and again. His thinking? I've already committed. These are too cheap to sell now. The sunk cost trap dressed up as conviction. In 2008, his flagship fund lost roughly 55% of its value. The broad market fell about 37%. He didn't just lose. He lost far worse than the market he'd beaten for 15 years. And here's the lesson. Even a brilliant investor can confuse holding on with being right. The longer he held, the more it cost him to admit he was wrong. That's not conviction. That's the trap. So how do you escape it? After 50 years, I've found the answer is just one question. Stop asking, what did I pay for this? That number is history. It's emotional baggage. Instead, ask this: would I buy this stock today, at this price, knowing everything I know now? If the answer is yes, then hold it, or even buy more. Not because you're down. Because it's genuinely a good business at a good price. But if the answer is no, then you're only holding it to avoid the pain of selling. And that, my friend, is the sunk cost trap talking. The greats understood this. Warren Buffett put it simply: risk comes from not knowing what you're doing. Holding a loser just because you bought it is not knowing what you're doing. And remember, this is educational content, not financial advice. Always do your own research. But the principle? The principle is timeless. Here's the one idea I want you to carry with you. Every decision you make should be about the future, never about the past you can't change. The money you've already lost is gone. It's a sunk cost. The only question that matters is what this investment does from today forward. The patient investor doesn't fall in love with a price tag. They fall in love with the truth even when the truth is uncomfortable. So let me ask you something. Have you ever held a stock too long, just to avoid admitting you were wrong? Be honest. Drop it in the comments, I read them all, and you'd be surprised how many of us have done exactly that. And if this changed how you think about your portfolio, hit subscribe. We do this every single day. Tomorrow, we're tackling the bias that makes you buy a stock just because everyone else is. It's even sneakier than this one.